Okay, so let's pick up where we left off yesterday. So there's one more lecture that I think goes into the fundamentals bracket, which is a set of basic questions around what people understand about taxes, how they perceive them, the extent to which they pay attention to them. And then, of course, after this lecture, we'll have our wonderful external speakers talking about various applications. So relative to yesterday, where we were primarily focused on situations in which people were making mistakes in the absence of any intervention, and then we were trying to put in interventions to try to counteract those mistakes, at least somewhat. The focus of today is actually on how standard, relatively standard tax tools might cause people to make mistakes because they are not correctly perceived or because they are not fully attended to. So what we want to relax here is the core assumption in public finance that all that really matters are the tax incentives that are in place, not how they are framed, described, and implemented. And this really is a core assumption. For example, it underlies a lot of modern optimal tax theory, where we think about mechanism design approaches to design, to thinking about optimal policy. And of course, to do mechanism design, you are essentially making a kind of implementation and variance assumption, because you're saying, I'm just going to think about the incentives and only later on will I worry about implementation of these optimal mechanisms with familiar looking tax systems. Okay. But of course, there's a lot of recent empirical work that challenges this assumption. People might be inattentive, confused, employ various heuristics to optimize with a complex tax schedule in place, and so forth. There's a very clean and simple illustration of this idea that comes from a real effort lab experiment by Abler and Jaeger, where people are putting in real effort that generates some payouts, and there's some kind of experimental tax scheme that's also in place. And what they're able to do is, holding incentives constant, consider one tax schedule that is described by 22 tax rules, and then another tax schedule that has the same incentives, but is described by one transparent tax rule. Okay, and what they find is that subjects exert, people are less responsive to incentives in the complex tax condition. Visibility of the tax matters. So there's a common finding replicated in a variety of different settings now, that people are not fully attentive to sales taxes. Right? So sales taxes are charged at the register. You're not really looking at them when you're going in to purchase a product. And so you might suspect that because they are not as in your face as the posted price, people might not react to them as much as they do to posted prices. And this has been confirmed in a number of different settings. People are more responsive to taxes that affect the posted price directly, like excise taxes, than they are to these less conspicuous sales taxes that are just added on at the register. Similar findings for road tolls, where, if you're just using Easy Pass and it's just kind of charged automatically, you're not going to be as responsive, and similar findings for income tax rules. There's also limited knowledge. Many taxpayers don't know their marginal tax rate. And of course, it's not even that easy to figure it out, given all of the different tax rules in place. So in some sense, it's not that surprising. And similarly, taxpayers can differ a lot in their knowledge or awareness of the EITC and the benefits that it generates. One form of this confusion, which is getting more into heuristics, is this very nice study by Feldman et al., that shows that when people lose the child tax credit, so that their average tax rate goes up, but not their marginal, what actually happens is that people reduce their reported wage income. And what that suggests is a confusion between average and marginal tax rates, or some kind of broader confusion about how the tax system works and what people should be inferring when they see their average tax rate going up. Okay, so that's just a very quick overview of the kinds of issues we're thinking about. I want to now zoom in and just dig a little bit deeper. So I want to think about first measurement and welfare implications of tax salience, and then two, measurement and implication of income tax misperceptions. Any comments or questions before I dig in? Okay, so let's start with the Chetty-Lunyan-Croft 2009 paper. Here's the empirical framework. So let's consider an economy with two goods, X and Y, with the price of Y normalized to 1 and P the pre-tax price of X. So Y is untaxed and X is subject to a sales tax tau that's not included in the posted price. So that means that the tax inclusive price of X is going to be Q equals 1 plus tau times P. And X of P comma tau is going to denote the demand for good X as a function of the posted price and the sales tax that's in place. Now, of course, if agents optimize fully, demand should only depend on the total tax inclusive price. So it shouldn't matter if we are in a situation in which the posted price is P and the sales tax is tau, or we are in a situation where the posted price is 1 plus tau times P and there's no sales tax in place. It shouldn't matter how you partition the total price that consumers actually face. And so what full optimization implies then is that the price elasticity should equal the gross of tax elasticity, which is just another way of saying it doesn't matter how you increase the total tax inclusive price. If you're a fully optimizing consumer, it shouldn't matter if you do it through the posted price component or through the tax component. Okay. So this is great because this is a very testable looking hypothesis. Okay. And we can test it by kind of doing our standard thing. To measure elasticity, elasticities we log linearize and we regress log demand on log price. Okay. Except here we're really going to take apart again the total tax inclusive price and think about log price and log gross of tax. And the key question is whether sigma equals 1, which is the full optimization assumption, or whether it is less than 1, meaning that people are less sensitive to variation in the sales tax than they are to variation in the price. So sigma here is going to be a measure of the extent to which people are attentive to the sales tax. Now, there are two strategies for estimating sigma, and these should be very familiar given everything we discussed last time. So one strategy is to basically manipulate tax salience by making the sales taxes visible as the posted price. Okay. And I'll go over this experimental strategy shortly, but just basically imagine an experiment that just makes posted prices tax inclusive. Okay. So you run this experiment, and what you are going to measure then is the impact on demand. But recall what we were talking about last time. So when we're looking at the impact on demand, that's the horizontal difference between kind of the observed demand curve and the one that would result if people were fully optimizing. Generally, we're interested in the vertical difference, and sigma is something that actually parametrizes the vertical difference. So the vertical difference, in fact, equals 1 minus sigma times the absolute value of the tax And so how do we go from horizontal differences to vertical differences? Well, Hunt taught us yesterday that for that you just need the elasticity of demand, right? Because that tells you the slope, and now we use geometry. Intuitively, think about it this way. Let's say that the sales tax is 10%, and this experimental strategy decreases demand by 5%. What that tells you then is that sigma is 1/2, because it is telling that the fact of making taxes salient makes people perceive the total tax inclusive price to be 5% higher, meaning that people were previously missing 5 percentage points of those 10 percentage points. If the impact of this intervention on demand is, let's say, 2.5%, that tells us that sigma is 3/4, and so forth. Okay. So that's strategy 1. Strategy 2 is just to compare, is literally to run this regression. For this, you need exogenous variation in both prices and taxes, and to look at these coefficients. Okay. Oops. Okay, so here's strategy 1. So they manipulated tax salience by generating new tax at a supermarket. And this is a major grocery chain where 30% of the products are subject to sales tax. And this was in a city with approximately 7.5% sales tax. And the data they have is scanner data on price and weekly quantity sold by product. Okay, so this is what it looks like. Above, you can see the original tag. This is what you normally see when you walk into a store. And below is the experimental tag that says, okay, it's actually this plus the sales tax, which gives you this total tax inclusive price. So it serves as a reminder. It serves as something that simplifies calculations. So what's the experimental strategy? Well, it's actually a triple difference strategy. Because within a store, some of the products subject to the tax are treated and others are not. Okay, and the treatment variation is actually at the aisle level. So for example, deodorants get the experimental tags, but toothpaste, which is in the same aisle, does not get an experimental tag. So that's one difference. Okay. You can also think about variation across stores. So treatment occurred in only one store, but there are 2 nearby stores with similar demographic characteristics that did not receive any experimental tags. And then finally, we can think about differences over time. The treatment period was for a specific 3 weeks, and we can consider what happened in other dates at which there was never any treated tags at all. So this is what it looks like. Here's the difference in difference estimate of the experimental tags that reduced demand by about 2 units. So this is just going over time and across products. Okay. Now, to really test all of the parallel trend assumptions underlying the difference in difference, you can consider a placebo test where you have the other 2 stores that never received the experimental tags, and you can perform the same difference in difference estimation there, okay, comparing differences in treated versus untreated products over time. And here, this is very comforting. In the placebo stores, the difference in difference estimate is 0. And then to be fully rigorous about comparing the treated stores to the placebo stores, here we can just take the difference between these double differences to get a triple difference estimate of a reduction of about 2.2 units. Okay. So that's the horizontal difference. Now, to really complete things, we need to get a price elasticity of demand, for which they just use some natural price variation across these different stores, and then combining this impact on quantity purchased with the price elasticity of demand gives a sigma of about 1/3. Okay, meaning that people react to these inconspicuous taxes as if they are 1/3 as large as they actually are. Now, what are some concerns about this experimental strategy here? Yes.
I think in some cases when the control and treatment will have different elasticity, that might, I see that having a problem.
You mean to go from this quantity effect to an estimate of sigma, we have to be careful about how we estimate the price elasticity.
Right.
Yes, good. Okay. But even before doing the translation, that's a great point. Before even doing the translation, what might be some other problems here? Well, one thing you might worry about is something like demand effects. People are not used to these new tags, so they might become actually overly sensitized. So it's a big assumption to say that with these tags, people are going to be fully optimizing. You might worry a little bit about left-digit bias because there are a lot of prices that end in something like 590 or 599. So one thing the tag does is it takes you from something that starts at $5, for example, to something that then starts at $6, which looks like a particularly large difference. You know, a 20-cent change that takes you from 590 to 610 does feel larger to many people than a 20-cent change that takes you from 570 to 590. Okay, so that's why it's one possible. I'm trying to do something multiple ways. This is one of the great things about this paper. They have a second strategy for thinking about tax salience. What they do here is they look at alcohol, which is subject to both sales taxes and excise taxes. Now, excise taxes are directly going to be affecting the prices that are posted, and so we have these two sources of variation, as long as there's variation both sales taxes and excise taxes. And to get this variation, they exploit state level changes. So here's a bin scatter of how of changes in log demand on changes in log of 1 plus beer excise rate. There's a clear response. People are clearly elastic to changes in excise taxes. And here's what it looks like when we do an analogous thing with changes in sales taxes. It's pretty flat. So it's much smaller elasticity. We can formalize this in a regression framework, you know, largely speaking across different specifications with different types of controls. What we see is a very significant response to changes in excise tax rates and a very muted response that is statistically indistinguishable from zero for sales tax rates. So across two strategies, what we see is that on average, people underreact to the sales taxes. Questions here? Comments? Okay, so now let's dig a little bit deeper. So these are results about average underreact. Oh, Don.
Just to add one point about that paper, I think is important, is for the grocery store experiment, they actually had a survey as people were exiting the store, where they asked them about what they thought the sales tax was. And the interesting thing in this paper is that they get it right. So people seem to know what the sales tax is. And for me, that's always kind of created a question mark about what the mechanism is here. Because, you know, Dmitry described another version of this, where this is something new and, you know, they're reacting strangely. Well, maybe that's what's going on. Or alternatively, you know, go back to this idea of context can affect salience. It may be that, you know I'm paying a tax. I don't like paying taxes. I know I'm paying taxes. I know what they are. I've taken them into account. I think, you know, I have that in mind. But if you rub it in my face, I'm going to get annoyed about paying taxes and get aversive to paying taxes. So you know, there are other things that could be going on here, and normally maybe we wouldn't think about those other things as being, you know, the likely mechanism. But the fact that people are shown in the paper to understand the taxes suggests maybe it's not characterization failure. So, and I think this paper does a better job of that. So,
well, thank you for that introduction. So these are excellent questions that I was wondering about as well. So let me tell you a little bit more about what I think are the mechanisms. Across two papers, there are two key facts that I find very interesting and that also kind of broadly inform us about what it means to be attentive or inattentive to inconspicuous incentives. So one is that people actually do pay more attention to larger size taxes. So that sigma parameter goes up when the stakes are higher. And two, there's actually a lot of heterogeneity where some consumers overreact in the sense that their sigma is actually larger than 1. And so the story these two facts suggest to me, and I'll go over the experimental design that generates these two facts in a moment, but the story that I want to suggest, since I was asking the question, is I think what it is people just being averse to performing the calculation. You know, if we don't want to think about the tax, there's a rule of thumb that we use. You know, and for some people, that rule of thumb is, you know, if your sales tax is 7%, I'm just going to act as if it's 10% because I know how to move the decimal point over. And then it's very easy for me to think about the tax. You know, there are other rules of thumb you might imagine where people might just add $1 and pretend the dollar is the sales tax for any item that's priced below $10 or $15, and then you do something else for higher priced items. And the way I think about it is there's this thing that we can do when we are not exerting any mental effort, or we can try to exert more mental effort, which we might be more motivated to do when the stakes are higher, and then we get closer to the truth in our computation of the tax, and then we act as if we are you know, our sigma is closer to 1. Yes.
Do you think this is a deliberate decision? Do you think people go to the grocery store and are looking at the toothpaste and are deciding do I exert the mental effort of multiplying this by 1.0735, or it's just more automatic and they don't even think about it?
Yeah, I mean, it depends a little bit on what exactly you mean by deliberate versus automatic. What I'm going to show you is that people are very responsive to stakes, right? So the sigmas get closer to 1 when the stakes are higher. To me, that suggests that it's at least in part deliberate. Now, you might argue, you know, maybe people just have like a meta strategy that at some point they just decided they do one thing when the stakes are higher and another thing when they're lower, then they don't think too hard about their attention strategy on a day-to-day basis. I don't know if you want to call that deliberate or automatic. You know, the word I don't want to use is rational. I don't want to use rational inattention. Deliberate inattention I'm fine using. I think it's a reasonable description of the facts that I want to suggest to you today. Okay, so let me talk to you. There's two papers. The one that really digs into these mechanisms is the paper with my student William Morrison, and so I'm just going to talk about that experiment. Yes.
Why wouldn't it be guilt? Because the Shetty paper specifically deals with like beauty products, for example, which is not necessarily a necessity. And we know that when you put calories next to like ice cream, people buy less ice cream. And so they may not necessarily be that people don't want to pay taxes. It might just be like, they're reminded of the higher price and they feel guilty. So I guess that's a point for your paper of using common household products instead.
But sorry, but under that story, that's still, you use the word reminded, right? So people are forgetting something in the mechanism that you described, because there is also price variation, right? And so the question still is, why are people more sensitive to price variation than they are to tax variation?
Okay, fair enough. I think.
But oh, sorry, go ahead.
I think there's a fundamental difference between like necessities and luxury goods, though, right? So it's like, what if people are just more price responsive to luxury goods as opposed to household goods?
Good. Okay, let me formalize this. I think this is an excellent comment. I would take your comment as follows, and I should repeat I forgot to repeat comments and questions. So your question is, people might feel, people feel guilty about spending in luxury goods, and being reminded that the luxury good is more expensive generates a strong response from people. So the way that I would put this is, there are a variety of reasons why people might choose to ignore taxes. So when I say that inattention is deliberate, I think the thing that probably immediately pops into your head is something that is closer to a rational inattention kind of framework, where there are just costs of computation. But we can be a little bit broader than that. Part of the cost of paying attention to the tax might be something like guilt, as you suggested. I think that's okay, and I think that would fit in with the kinds of results that I'm about to show you. And then the second part of your comment, I think, motivates an interesting testable hypothesis, which is, I think that people's attention should be more elastic to stakes when it comes to luxury goods than non-luxury goods. I think that could well be true. I'm not sure I have the data to test that, but I think that would be very interesting to look at, whether there are predictable predictors of heterogeneity across products. And heterogeneity is very important, as I'll formalize in an efficiency cost framework in about 5 minutes. So I think your question is especially interesting for that reason.
Floating paper idea then, so.
Any other comments or questions? Yes.
Do you think it would make sense to wonder whether, in a sense, people perceive the tax rate in levels, in a sense, meaning if it's not posted, if it's not included in the posted price, the tax, I kind of know that there is a 3% on all products, and I might perceive that as kind of equally distributed, say, across products or in levels, in a sense. Whereas seeing the price that includes the tax actually shows me by how much this single price increases, and so how post-tax price become comparable. I think I have in mind a comparability thing where if you don't see the tax posted, you would kind of treat it as something that would apply equally across products, so you don't need to treat it as a rate, as a percentage. See what I mean?
Yeah, I mean, does it matter if we describe the taxes as 3%, or we describe them as this is the absolute monetary amount of the tax? That's your question, right?
Right, and like the behavior, if you want, I was like thinking perhaps, you enter the store, you kind of know that there's gonna be a 10% applied to all products, so you think, okay, whatever I buy, it's gonna be a 10%, you see what I mean? So I don't really take into account that for larger prices,
Okay, well, that is a hypothesis that I can show you doesn't hold up completely in the data. So let me show you some of the data. So to dig more into heterogeneity, what you need is a lot of within-person variation. And so what we created is kind of an experimental panel data set where people are making a bunch of different purchase decisions across different products, across different prices, and in fact, across different tax regimes as well. Okay, so people sometimes enter what just experimentally is just described as store A, where there's no sales tax. Sometimes they shop in store B, which is described here. You pay the standard sales tax that you pay in your city of residence on standard non-tax exempt items. And then there's a store C, where there's a triple the standard sales tax rate that you pay in your city of residence on standard non-tax exempt items. So all of the variation here is within person. And so one of the things we can construct then is the following figure. So here we are computing the y-axis as sigma. Okay, so the same sigma that we were talking about in the Cherry-Levine-Croft paper. And the exercise here is as follows. So first, let's look at the store with the standard tax rate. What I'm showing you here is what we compute the average sigma to be. Okay. When we restrict the product whose prices are $7 or lower. Okay. This is products with prices $8 or lower, and so forth. And the identification here is along the lines of basically both strategy 1 and strategy 2 actually in Cherry-Levine-Croft, because within person, we have both the no tax store and the standard tax store, so we know how people respond to prices, and we also see how people go from a no tax store to a standard tax store. Okay, but we also have all of this price variation. So in Cherry-Levine-Croft, you are limited to the price variation that you have. Here we have tons of different prices that consumers are facing. So the first pattern that you see here is that in the standard tax store, people are more sensitive to taxes at higher prices. Okay. So I think this gets up to what you were talking about. People realize that at higher prices, the absolute value of the tax is higher. And so they do more to try to react to it correctly. The second pattern that you see here is that when we make the sales taxes higher through a different source of variation, so we say instead of standard, you have to do triple. By the way, we never actually tell them what this tax is. This is how it's described, because we want to make it otherwise as comparable as possible to their standard experience. So this is just kind of a, there's a transparent way in which we're describing the increase to them without actually saying what the tax rate is. But consistent with what Doug was saying, in this experiment, we similarly see that around 70% of the people know their sales tax rate within half a percentage point. So it's really not about knowledge. Okay. It's something that has to do, I think, with cognitive effort, because when it's transparently described as a larger sales tax, you also see a sigma that's on average higher. It's still on average below 1, but it's definitely higher. Okay. They can do another exercise, and you can ask, do these sources of variation kind of produce similar responses to sigma? And so instead, what I'm talking about here is the average tax owed. So I'm binning the products into bins of 2 prices each. As long as you have 2 prices, that's enough to estimate a sigma. You just need a little bit of price variation. And so what I'm plotting here now is basically the x-axis is the average tax owed across the different bins. And we have 5 bins from standard tax store and 5 bins from the triple tax store. Now, there's not that much overlap because overall the absolute value of the tax is significantly higher, but you don't see any kind of major trend break that you might expect if you thought there was something especially weird about tripling taxes that oversensitizes people. You know, the confidence intervals are a little bit wide, but there's nothing suspicious here. It looks like mostly kind of a continuous trend. Okay. People, sigma on average is just higher and higher stakes. So that's result 1. Now, the other thing we do, because we have multiple products per person and so multiple opportunities to estimate a sigma for each person, we can study individual differences. Okay. So here is what I'm showing you in the first column here. In the first column here, what we compute is a lower bound on the variance of people's sigmas in the standard tax store. And the lower bound on this variance is actually very high, 0.83, so close to 1. Okay. From this, if you make the assumption that sigma is not less than 0 for anyone, meaning that no one pretends that taxes are subsidies, you can actually start making inferences about what the support of sigma looks like. And this variance estimate tells you immediately that there have to be some people whose sigmas are greater than 1. Non-parametrically, I'm not estimating any kind of parametric distribution of sigma. There's a non-parametric approach to generating lower bounds on the variance, and I'm just telling you immediately from this lower bound we can conclude that sigma has to be larger than 1 for some people. Can anyone explain why? How do we know that sigma has, and in fact, this is the lower bound on the supremum. So we know that if you compare, if you look at the support of sigma, there has to be a positive measure of people whose sigma is in fact at least 2.2. How do we know? Well, let me ask you this question. If you have a random variable with support on the unit interval, what is the max variance of this random variable? Can the variance be anything? Or is there an upper bound on the variance? Well, let's think intuitively. We have a random variable, it's supported on the unit interval. The best way to get to the highest variance is to make it maximally dispersed. How do you make the variable maximally dispersed? Well, you put all mass on either 0 or 1. So we're talking about a Bernoulli random variable. Okay. And then in fact, and we know how to compute variances of Bernoulli random variables, p times 1 minus p. And that's maximized where at p equals a half. So the maximum variance is a quarter. Okay, that's the intuition, but it's a very easy to prove result. So maximum variance of a random variable supported on the unit interval is a quarter. So when you see this, you know it's not supported on the unit interval. And in fact, you can extend the intuition I gave you to generate lower bounds on the supremum. So if you know something about the mean and the variance together actually give you bounds on how expansive that support has to be. Okay, so we know that it also can't just be supported from 0 to 1.5. That gives you cannot attain a variance this high, given the mean if it's only supported on 0 to 1.5. So that's how you can start making kind of very robust non-parametric bounds on the support of the random variable. Similar results for sigma in the triple tax condition. Okay. And then the third thing we can do is, because this is within subject, we can also look at how people adjust. So for each person, you can define an adjustment term, which is how their sigma change, which is the difference between their sigma in the standard tax score and their sigma in the triple tax score. There's a lot of heterogeneity adjustment as well. And one of the things we can show is that some people adjust downward. Okay, so it's not just all people adjust upward. What we can also show is that people adjust downward, and by quite a bit. Okay, so we can show that some people adjust downward by as much as 0.94. Okay, and so this is consistent with this broader story that I was telling you, where there's actually both under and overreaction, probably because people just have very heterogeneous rules of thumb that they choose to apply when they are not generating any mental effort. But when the stakes increase, we put in more mental effort. And so the rules of thumb become used less, and our sigmas then converge closer to 1. Okay. So that's my view of what's going on. And then more broadly about attention, one thing that now that I say it, it sounds kind of simple and obvious, but one thing that I've kind of learned for myself from this is, when we talk about an intention, we shouldn't just mean that an intention means ignoring the thing that's in front of you. Here, an intention actually means using just some kind of automatic rule of thumb, which is not the same thing as just ignoring the tax. Yes?
How do you account for measurement error? So even if you have homogeneity in sigma, you will get a positive variance just because each sigma is
okay, good. I wasn't gonna start complaining about this, but you got me. Okay, there's a thing that people who are focused on lab experiments do, which drives me crazy. Which is, what you would basically do is, for each person, you just get a point estimate of sigma. And then you plot that distribution and you say, okay, let's learn about heterogeneity from this distribution. Now, as you pointed out, that's of course completely wrong, because when you plot that distribution of sigma hats, What it is actually a convolution of true individual differences and a bunch of measurement error or noise. And without having something else, we have no idea how much of it is actually real individual differences. As far as we're concerned, it could all be noise. What is the intuition then for how we can do robust inferences on individual differences? Well, recall that there are multiple products per person. Okay, so under your hypothesis, under the null hypothesis that sigma is in truth homogeneous, roughly speaking, what we would see is that there is no persistence across different products in the person's sigma. Right? A person for whom we estimate a high sigma on one product is not going to have a higher sigma for a different set of products. Okay. So it's actually the degree to which people's sensitivity to taxes is correlated across different products that informs us about individual differences. And one of the things that we develop in the paper is a formalization of this intuition that is actually quite general. So, for example, if you just made the assumption that sigma hat is the true sigma plus a noise term epsilon that is independent of sigma, then it's very easy to calculate the variance of true sigma, because then as long as you have two sigma hats, you take the covariance, and then by assumption of independent noise, the covariance actually just equals the variance of the true sigma. You don't need to make an assumption that's strong. So what we show in the paper is a generalization of this intuition that shows that, roughly speaking, it's something like this covariance, but when you take it, when you have non-classical measurement error, it actually gives you a lower bound rather than an exact point estimate of the variance. So great question. I will then just actually advertise, if you want to do kind of individual differences in this kind of robust and non-parametric way as possible, we have some tools in this paper for doing it. Definitely do not do this thing where you just estimate something at the individual level and you plot that distribution of parameters. Definitely do not do that.
So are you a little bit too negative because we usually have some information about how precisely we're estimating the sigmas, and if we do some shrinkage on the distribution, we're estimating them. So that is an alternative way of approaching it. So you have, like, you can estimate the sigma for each individual, and you have a confidence you can follow how precisely you estimate the distribution at each individual. So now you can look at the variance and then apply some shrinkage procedure accounting for the.
I think the consistent estimator of the optimal shrinkage. So what I was suggesting is a form of shrinkage factor estimation, right? Because by how much do you shrink? Well, it actually depends on the covariance between two different point estimates of sigma, right? If they're completely uncorrelated, you have to shrink everything to the mean. If they are very strongly correlated, you don't shrink everything to the mean. Now you're suggesting that we could make inferences about the covariance just by looking at the standard error, which I'm not.
I would take an average of those standard errors, for instance, to shrink them.
Which I'm not sure is the case. I think it depends on what goes into the standard error. Right, because one way of getting the standard errors for low, for example, is just to have enormous variation in both prices and taxes. And then so you're somehow saying we learn a lot more about individual differences when we have this enormous variation, which I'm not sure is true, because I'm not sure that larger variation in prices and taxes changes what would be the covariance. But let's talk more about this. Yeah, I don't mean to say that, so I should be, it's not like there's no information, because we can, for example, even just have priors on how much noise there is. So we can be Bayesian about looking at the distribution of point estimates. But if our goal is to study individual differences, we definitely should not feel satisfied with that. Shrinkage estimators is something we should always have in mind. You know, in worst case scenario is you can try to think of what would be a plausible shrinkage estimator. You know, I think the most robust way of getting the optimal shrinkage is from exactly the intuition that I described, where you have multiple measures per person. But I think this is useful to think more about. Okay, let's talk about implications for welfare. To do welfare, the literature has made the following two assumptions. Although one of them I should already preface, we probably should be walking back. One is that utility depends only on the final consumption bundle. Two is consumers optimize perfectly in the absence of taxes. And then there's a third assumption that we normally make, but that we're just going to dispense with, which is that consumers optimize perfectly in the presence of taxes. The reason I like writing it this way is to make it transparent that this is a generalization of the standard approach in public finance to thinking about the welfare consequences of taxation. We're not making new assumptions, we're just eliminating one of the assumptions that we normally make. Now, in the context of everything that Doug talked about yesterday, you should think of assumption one as defining the scope of consumers' concerns, and assumption two is defining the welfare relevant domain. Okay, by not making assumption three, we're just allowing for there to be a difference in how people choose between the welfare relevant domain and a different frame, where sales taxes are not included in the posted prices. Okay. Now, the reason, so this is where Chetty and Looney and Croft started. This is the set of assumptions that I make in my paper. I actually now really do want to pick on assumption one, though, because it's inconsistent with everything I was just telling you about, where people's intention might be deliberate and responsive to changes in incentives. I think what those results suggest is that the scope of consumers' concerns is broader than just a final consumption bundle. It includes something like the cost of mental effort. Okay. So actually, that would be a violation of assumption one here. Okay. But let's just roll with this for now, and then we can talk about how we would modify the formula by incorporating mental effort costs, meaning and thus broadening the scope of consumers' concerns. Okay, let's go back to the syntax formula from Hunt. It's a good thing we talked about that a lot yesterday, because everything goes back to that. Remember how we thought about the impact on welfare of a change in the tax T. Okay, and we're setting aside redistributive concerns here, so that mechanical effect is just going to be 0. So with that redistributive concerns, we have two effects: the bias correction and the fiscal externality. Okay, so we have bias gamma again. Gamma is the vertical difference between the two demand curves. dx dt is just how demand responds to the tax. Okay. And we have the fiscal externality. People consume less of the good, you get to collect less tax revenue. Okay. So starting with this formula, let's just plug in what gamma is. Actually, this is a slight reinterpretation of gamma because we're not talking about bias on the good itself, but it's the same thing. When people are underreacting or overreacting to taxes, it's the same thing as over or underestimating the utility from the purchase. So with the tiny reinterpretation of bias in the syntax formula, we can say that in this framework, gamma is 1 minus sigma times the tax. Okay. If you have a sigma of 1/2, what it means is that you are actually overestimating the utility from the purchase, but by 1/2 the tax. So now you can plug this into the formula, and a teeny bit of algebra gets you to this result, which is the formula in Chetty, Looney, and Croft. Okay, the deadweight loss of taxation is going to be sigma times the tax times the change in demand. That's the impact on the deadweight loss of taxation. Now this is at the person level. So if you assume that sigma is homogeneous and you change this to just the derivative of demand, that's the formula in Chetty, Looney, and Croft. But we can modify this because we learned that sigma is actually heterogeneous. There's kind of a very mechanical and simple looking modification that occurs with heterogeneous sigma because the change in demand with respect to the tax is itself also going to be proportional to sigma, right? The more you pay attention to the tax, the more responsive you're going to be to the tax. And so what you get then is actually the second moment of sigma and the formula. Okay? Because we already have a sigma once to modify the elasticity with respect to demand, and we have a second sigma and how we translate from the elasticity with respect to the tax to the elasticity with respect to the price. So in fact, the more general formula looks like this, and this is also possibly with various rates of the pass-through parameter. So there's two things that actually matter. There's the average sigma, and that modifies the total derivative of equilibrium demand with respect to the tax. Here, I'm not necessarily assuming that prices are exogenous. They might change with respect to the tax. And then there's a second term, which is the variance of sigma, which modifies the partial derivative of demand. And then tuition for this formula goes back to what I was talking about yesterday, actually, when I was covering non-financial policy instruments, which is that noise is bad. Okay? So the higher is the variance, the higher is the deadweight loss of taxation. And it just goes back to this intuition that what we want is consumers who derive higher value from the good to be the ones purchasing it. When you have heterogeneity and sensitivity to taxes, you get into situations where you have low value consumers purchasing the good, high value consumers not purchasing the good, and it's bad. And you have similar results to what I was talking about in the case of non-financial policy instruments, where, for example, even if you have like a vertical supply curve, so the equilibrium quantity in the market is fixed, that's a situation where if sigma was homogeneous, there would be no deadweight loss of taxation because taxes don't change the equilibrium quantity at all. But with heterogeneity in sigma, all of a sudden taxes do generate deadweight loss because it's now taxes combined with heterogeneous perceptions of taxes that generates noise in the market. Okay, so with heterogeneous attention to taxes, higher taxes you should think of as generating more noise, and that's an additional source of deadweight loss. So in fact, one of the things that happens is if you take the kinds of bounds that we compute in the Morrison-Taubinsky paper and plug it into formulas like this, one of the things you learn is that even though on average people underreact to taxes, which might lead you to want to think that that's good because it reduces fiscal externalities, the variance is actually so high that all of the noise and these non-saliently posted prices actually makes them less efficient than salient taxes that would just be included in posted prices and to which people on average would actually be more sensitive. Any questions here? Okay, I have 5 minutes left. I'm going to try to quickly summarize some of the work on how people misperceive income taxes. And what we're studying in this paper, let me show you a picture, is two kinds of heuristics for how people might perceive an income tax. So one, this is coming from Liebman and Zackhauser, is that when you have a kind of complex nonlinear tax schedule, you might engage in what they call ironing, which is you say, I don't want to think about the nonlinear thing. I like linear. I know what to do with linear. Okay. Now, when you say it's linear, there's a question of what's the slope. And there's a very natural candidate for the slope, at least with respect to income taxes, which is the average tax rate. Like when you file your taxes, around April 15th with TurboTax. It tells you what your effective tax rate was. Maybe makes you mad, so it's very salient. There's a lot of emotion tied into it, so you remember your effective tax rate. And so that's a natural candidate for the slope of how you approximate the nonlinear thing with the linear thing. Okay, so ironing is secant lines that go through this. Okay. There's an alternative, which I think maybe makes a little bit intuitively less sense, but we can still test for it in the context of income taxes, might make more sense in other contexts, which is spotlighting, which is, again, I want to linearize because nonlinear things are complicated. You know, and it's a perfectly fine approach to problem. Like we as economists do it all the time, physicists do it all the time. Linearization is great. It's just a question of the slope. And in some sense, spotlighting is actually the better way to linearize because here we're considering tangent lines. So for marginal decisions, it doesn't really generate mistakes. If you're making non-marginal decisions, like extensive margin decisions about employment, then spotlighting is going to lead you to make mistakes. So those are the two things. So ironing, which is secant lines, and spotlighting, which is tangent lines. And so to get to that, we basically generated a data set where we created tax filers very similar to the survey respondents, but we varied the tax filers' gross income. And then we asked the survey respondents for these different levels of gross income, what do you think would be the tax that they pay? So that the outcome of this procedure is basically eliciting people's perception of the income tax rate. Okay, so look at this panel here, for example. This is for married filing jointly. The dashed line is the true tax that they pay. And this line here with a little bit of a shaded confidence interval is their perceptions. And what overall you see is that on average, people are not that far off, but what happens is they overestimate the tax at the low end, and they underestimate the tax at the high end. What you also see is that as the respondent's own income changes, the point at which overestimation changes to underestimation changes as well. That point moves to the right. So the higher you are, the more likely you are to overestimate taxes on lower incomes, and less likely you are to underestimate taxes on higher incomes. So there are a bunch of patterns in the data around how overestimation and general flattening of the tax schedule, and all of these patterns are in reduced form totally consistent with ironing. So you can see, for example, ironing predicts that the higher income you are, the steeper is that tangent line, or sorry, secant line, the more overestimation there is and the less underestimation there is. So this is all very much consistent with ironing, and using this kind of variation, we can estimate a mixture model where we have some ironers, we have some spotlighters in the population, and we have what we call kind of residual misperceptions, which is any other kind of misperception of the income tax schedule that is independent of the survey respondents' income. And the result is we find that almost half of the population irons and basically no one spotlights, and this is reasonably tightly estimated. And here's just what it looks like in pictures. When you do an individual level classification, here's what the ironers look like. They really do look like ironers. You know, their perceptions look pretty linear, and they intersect the true tax schedule right around the respondent's income. The people who don't look like ironers don't look like ironers. They just have misperceptions that are not dependent on their own income. There's a tiny bit of overestimation coming from not exactly clear what. Maybe people just including state taxes into questions about federal taxes. You know, but it's nothing interesting going on. But, you know, this is ironers. It really looks like ironing. Perceptions are on a flat line that moves with survey or on a straight line that moves with survey respondents' incomes. This has welfare implications that I'm not going to go into. So I will just summarize. So when incentives are complex or opaque, people misreact to them. The welfare implications of this are subtle. On the one hand, we have this intuition that we kind of is very common, especially if you're coming more from public finance, which is anything that makes you react less to taxes is good because it reduces fiscal externalities. But it's more subtle than that because heterogeneity in this misreaction can be quite inefficient. And also, I didn't touch on this, but it's part of the welfare results when we're talking about income taxes, how this misperception co-varies with income matters. And that again goes back to the kinds of things Tom was talking about with sin taxes, matters whether the bias is concentrated on lower or higher income. So it is definitely more subtle than just talking about an average fiscal externalities going down. What I want to think about, and I think a lot of people kind of pick on this very correctly, and I think this is really a potentially very interesting set of research questions, is around this notion of why do people dislike complexity so much? I think a lot of people have an inherent dislike for complexity, despite complexity being potentially beneficial. And another question to think about is, even if we identify situations where complexity is beneficial from a standard cost-benefit analysis, is that really the right welfare function? Is it really right? Does it sound palpable to say, let's make the taxes more opaque and complex to optimally reduce fiscal externalities? A lot of our intuitions is that doesn't seem quite right. And I think that's a really interesting research question that might get into a nice agenda that's around the intersection of social preferences and cognitive biases as they relate to questions about welfare and policy design. I'll end here.